right, Mikey. That's how we'll launch. Okay, so there's an interesting trend that you're noticing, or at least that you noticed this last week, right?
Yeah, during the capital raises?
During the capital raises. So whenever we're in a capital raise, at least Michael, and then it seems like we just put so much more attention towards investors in those moments where maybe we're not doing capital raises, it's focusing on, I don't know, more maintenance stuff. And you came into my office the other day and you're like, dude, I don't know what this is, but I keep talking to these people who are like managing investors or have like an investment group, and they have no clue what they're talking about. Like, they should not be doing this, right?
Yep.
And then I was like, oh, that's interesting, because what I'm hearing from like the influencer or people on stage is everyone should be creating fund to funds, right? So why don't you explain what you are noticing and hearing, and then we'll kind of talk about fund to funds and what that is and who should be doing it, who you should be staying clear of.
So people that are seeing our deals are opting in to talk to us. And when I get on the phone or on a Zoom call with them, the conversation eventually gets to, it's not them being the investor that's interested for themselves. It's they've aggregated capital, or at least they say they have, to the tune of 10, 20, 30 million bucks in some cases.
That high?
That's what they're saying. For all I know,
I mean, call it $1 million.
They don't even have it committed. They just think that they can get it.
Even if they've put together $1 million.
Correct. If they can. And they're actually looking at it for a group of quote unquote investors that they're representing on this deal. And as I'm beginning to talk, so when they come in that way, I'm thinking to myself, okay, the conversation is different, because the conversation with, an entrepreneur or a professional, they don't often know a lot about real estate, right? And so you're having kind of more of like a baseline conversation, more educational in nature, kind of explaining to them, how things come about and a lot of the why behind the decision making. And then with people like this, you generally have an expectation that they're experienced in real estate investing. And so you can go a little bit more into the weeds and get...
it's less educational and going straight towards
Yeah, but you can also get into like the nuanced conversation about, specifics. Like, so for example, like I wouldn't talk to a retail investor like about debt yield, right? Which is a mechanism for financing. With a very sophisticated retail investor who's representing a group of investors to the tune of $30 million, debt yield should be very important for them, because that will determine refinance. And without having to get into all the details in this conversation, it's a different topic, right, that we touch on with them. And what I'm finding is these guys don't know what they're talking about. They're not even at the level of some of the retail entrepreneur level investors that I'm talking to, and some of their expectations are wild. And after having like one of them here, one of them there, no big deal. But when I start having like 5, 6 of them in a week, all of a sudden I'm looking around and saying to myself, that's what prompted me to come into your office to say, what is going on? Where are these people having access to this kind of money? Because they're just the middleman. So who's putting money in with these guys, and why aren't these investors going straight to the source?
Right.
And that's when you told me that there are all these courses out there.
Well, I don't know if there's courses, but this is basically what happened. And
or people that are teaching it.
Okay. So I was in Idaho over the summer at AJ Osborne's storage conference, right? And Pace was speaking on stage, and he kind of just threw it out there like, oh yeah, like if you don't know about fund to fund, like that is a crazy opportunity that not a lot of people are participating in, right? And this is no like shot at Pace. Like there is a lot of value in doing that, considering you know what you're doing, right? And just as he said that, I was like, dang, I wonder if that's going to be the next product or bundle of information that the real estate influencer sells, is how to create a fund to fund, right? And I haven't thought of it since. And then when you came in here and said that, my first thought was, dang, I bet you they're selling courses on how to create a fund-to-fund model where you can raise money from investors or your friends and participate in a percentage of the carried interest or fee structure that you create, and then you invest that in other groups like ours, and you don't have to know real estate, you don't have to find the deal, you don't have to manage it. Like, you're just bundling or putting capital together. That's what I'm thinking. I don't know if that's what's happened, but that was my first thought.
So that has to be a friends and family play, right?
Well,
they can't be aggregating that much capital from outside sources.
It doesn't have to be
by a business model.
It does not have to be a friends and family play. At least through the lens of, can you take the legality of this thing out for just a second? What you're really asking yourself is, do I have a network of people that would put their money into me, right? There's a lot of people that have a big network that could do this, right? But if you're an influencer or you're somebody who understands digital marketing, yeah, you could very easily fill an investment, right?
So you don't think the people that are investing with these guys understand that they're sometimes 3 levels removed from a deal?
No, not at all. I think a lot of people don't. Well, now there's assumptions I'm making right now, but I would say most people don't understand the layers to putting together a deal. And then I think there's a percentage of people that just look at it as, look, I have no idea where to invest this. I don't have access to deals. Like, you could be let's say I'm going to create a fund-to-fund, right? We wouldn't have started Commune. I sold St. Archer. I just wanted to invest after that. And I just looked around at all my friends or, the investors that we had just made a ton of money for in St. Archer. And I was like, hey, you know what? I'm going to start investing in some real estate deals with friends I know. Anybody want to ride along with me? You don't think there'd be a percentage of people that I want to invest where you're investing?
Yeah, friends and family for sure. I just don't know that it goes beyond that network.
Oh, so you're saying all of our investors you would consider friends? They wouldn't just be like a network?
Yeah, I don't know. I guess it depends. I guess it depends on the person. It just seems odd to me that somebody has access to $35 million and they don't have their hands on the deal that they're putting their people's money behind.
I don't think they have. I don't think they have 35 million. I bet you it's no more. I bet you it's no more than 3. I think he was lying.
Yeah, it's possible. It's not one guy. It's a handful of them. That was what was so alarming, was there was so many people. And then I thought to myself, okay, what don't these investors quite understand about investing with somebody who's effectively acting like a broker, right? Because these people that are fund to fund, they have no control over the deal.
Well, hang on. Let's take a step back, because we're probably talking about some things that the audience is going, wait, fund to fund, syndicate. What does any of this mean? So let's first kind of just break this down real quick. What the different levels of putting together a real estate offering are.
All right. So
let's start at like the most basic.
Syndication?
No, not even a syndication. Like, what if like you, me, and the boys want to put together a partnership real quick and buy some real estate? That's
okay.
4.
So that at the most simple level is the 4 of us come together. We create an entity, an LLC. There's 4 partners, 25% each. We each put $100,000 into it. We go out and we buy a deal. For every dollar that comes in, each one of us captures 25 cents on that dollar. Then that's
the most basic.
That's the most simplistic, basic, way you could do it.
And we're not selling.
Actually, arguably the most simplistic is somebody does it by themselves, but more likely it's a group.
We're not selling security. You don't have to worry about a lot of the regulation that we.
It's 4 quote unquote GPs, general partners. Nobody's passive. Everybody's equal share. Super straight up and simple. Next layer above that is a syndication. Syndication is where you have a central manager who is bringing the deal to a group of people and saying, I need to raise, let's just say $1 million. And he brings in 10 people at $100,000 a piece. They each own 10% of the deal, and you go out and you do the deal. And you have no say in the business. You don't make operational decisions. You default to the general person who brought you the deal. So they kind of, have one guy who's making all the day-to-day operational decisions. Everyone else is just getting the cash flow from the income that comes
So you have a split between a general partner or the general partnership of people, and then you have the limited partners, the investors that came in, right?
Yeah, but I'm assuming in this scenario, the general partner also put in 100 grand. So $1 million deal, the general partner put in 100 grand and then brought 9 more people for 100 grand, $1 million total. And then the general partner not only has 10% of the deal, but probably gets some sort of a kicker on top of it for doing the lifting.
And he's managing it. He's the controller.
Yeah. And the investors, the 9 people, are really hands off. They're just kind of sitting on the sidelines watching the deal kind of happen. And maybe they vote on some decisions. More than likely, if it's a general partner who's pretty seasoned, they'll have the acumen to not have too much shareholder input on decisions because it just bogs down the system in many cases. So that's your syndication, which is probably what we see the most out there, right? Single property, one deal at a time, keeps going back to the same 9 people, or as the deals get bigger, expands beyond that circle.
Yeah, in our size of real estate, that's what we see a lot. The $5 to $100 million deals. It's a lot of syndications. Maybe 100 is maybe north of maybe 5 to 60 million. You see a lot of.
I mean, I've seen some of the syndications in the $1 million ranges too.
Okay.
Yeah, so they can get small also. And then you have a fund. And a fund is really a group of syndications in one deal. So think parent company, and then the parent company is what goes out and buys all the individual assets. And so the investors own the entity at the top of the house. The entity at the top of the house owns the sub-entities, which are on title on the properties themselves. And so in that scenario, you're talking about probably hundreds of investors at this point now because it's a lot more deals, it's a lot more capital. Now you're in the 50, 60, 100 plus $1 million range. And so that's kind of like the next level up. Now in that scenario, investors are truly removed from day-to-day operations, from decision-making. There's a handful of kind of shareholder rights that they have where they have to vote if there's an amendment to how the parent entity is operating. They'll have to vote on stuff like that or at least have disclosures made to them. It's way more complex. There's pros and cons, I would say, to syndication versus a fund. But that's, kind of like that next level up where, I mean, there are funds that have hundreds or thousands of properties in them. And so these guys are basically spinning up a fund, an investment vehicle that's going to, let's say, put $10 million into it. And the investors that come into the fund or into this parent company are going to invest a little bit in Commune, a little bit in BlackRock, a little bit in here, a little bit in there. And so they're aggregating basically private equity investments on behalf of their investors that own the parent company. And that person, for vetting where the dollars go, for overseeing what's happening with them, for reporting back to the investors, is getting paid something, whether it's a fee, whether it's a split of the profits. They're making their money some way, shape, or form. It really depends on how they're doing it. So that's kind of who these people are that have started to pop in. There are these fund-to-fund guys where they have a fund with all their investors, and they take a portion of the money in that fund and they invest in, let's say, one of our real estate funds where there's, 10, 20 properties in them. So that's kind of the background of how this works.
And there's nothing wrong with doing a fund-to-fund.
There's nothing wrong with doing
the
a fund-to-fund.
problem is that you're seeing, and that what we're talking about is, it seems like some of the fund managers or the person representing the fund has no clue what they're doing. The questions they're asking and the expectation is so wildly off that you're saying, oh man, for whoever the investors are in this fund with them, I would be terrified if I were them. That's what you're saying.
I'm saying investor beware.
Investor beware.
Right? You have to, if you're putting dollars in, and 35 million, assuming that.
There's no way, bro.
I agree. But, let's take it at face value, right? If that was the case for this, that's a lot of money to be put into somebody's hands. And based on the questions I was asking and the answers I was getting, I wouldn't have put $1 with this person, right? And so I look at that and I say, if you're the investor who's investing, are you asking the right questions Or are you just taking the relationship you have with this person for what it is and putting money with them? And then it's concerning because you start to see this kind of pattern developing where, the fund manager can make some bad decisions, invest in some companies that they didn't properly vet, they didn't thoroughly understand, they don't have shareholder controls over. And all of a sudden, he's putting his friends and family members' money in a deal that he or she doesn't understand. And if that deal goes south, this person in the middle is saying, wasn't my money. It is what it is. I can't do anything about it. And all these investors who put all their belief and faith in this fund manager are now, SOL because their money's gone and they can only learn the lesson after the fact. And it just caused me to think about, we've had too many scenarios in our past where investors have been taken. And there's a level of due diligence and vetting you as an investor have to do before you're writing a check.
What do you mean what do you mean investors have been taken? You hear horror stories of an investor losing money.
I mean, how many Ponzi schemes have been out there? The Bernie Madoffs of the world, things like that, where it's just people are writing checks because the person that's asking them is somebody they know well, somebody they trust, somebody maybe they feel like they have an obligation to write a check to invest with them.
Or somebody who's good at selling.
Or somebody who's very good at selling, and you're not asking the questions because what you're being sold is an emotion or a fear of missing out, and that's compelling you to write the check, and you're not really fully understanding what you're investing in. Now, there's a flip side to that equation too, which we talked about in the past, which is overanalyzing something, right? So you don't want to be so far that you get paralyzed because you're analyzing something so much that you don't end up making a decision. But what I'm seeing now is the flip side of that, which is these fund managers, based on the questions that they're asking, they don't understand. So who is putting money with these guys into somebody who doesn't understand how to vet deals that he's putting other people's money into?
Okay, so if you're an investor, maybe these investors don't know the questions to ask, or maybe they're how would you say this? Their knowledge of real estate investment is very rudimentary, very beginner. What do they ask them? Like what are some of the questions that they should be asking these guys?
So I'll share with you the questions that I ask, right? I want to know first and foremost what...
Meaning I'm a fund manager and I know you. I'm like, Mikey, dude, I've got this investment vehicle. We are crushing it. I've been doing this for X amount of years. I'm invested in these big, operators. You're missing out. Let's get involved. What are you waiting for?
Okay.
Are you sick of paying taxes? I give you all the juice, right? The stuff you're not even supposed to say.
Right. So the first, this isn't linear, right? So it's not like this is a sequence of questions, but the questions that come to my mind, if that were to come up, would be first and foremost, what is your philosophy? Tell me what drives you to make the decisions that you're making. I don't want to know about the product. The product right now is irrelevant to me. Tell me how you're making decisions. Tell me why you're making these decisions. So that's kind of the first thing I would want to understand. Second thing is, I want to know if you have skin in this game too.
Wait, hang on. Before you move on to number two. Number one. So when you ask, I want to know how you're making decisions. You want to know, why are you buying this property in this location? How did you get to these numbers that you're including in your financial models? Why are you using this cap rate? Is that, et cetera, et cetera. Where are you going to start seeing red flags?
If I'm not seeing a rational thought process, and the problem with that is that you have to be somewhat educated in the space to make sure that it's rational. But if
for example, if you were like, Mikey, how you're showing here that you're gonna develop this apartment in 12 months and you're gonna lease it up in 4. Tell me about that. Why do you think that's the case? And you're gonna say, if my response is, well, we develop faster than everyone else, and there's just so much demand. I mean, look at real estate, what it's done in the last 2 years. Like, it's crazy. 97% occupancy, rent growth by 9%. Yeah, we're going to fill it up. What are you going to say to that?
Yeah, it's scary. It scares the crap out of me. Tell me about a mistake that you've made. We haven't made mistakes. We've been fortunate to do it. How do you hedge against risk? There are really no risks in this deal. It's real estate, and real estate is kind of a quote unquote guaranteed investment because it's finite in nature. And if I'm starting to hear all these things where everything I'm asking for ends up being a pitch, I've got a lot of red flags coming up because there is no single investment that exists out there that's risk-free. It just doesn't exist. So there are risks in real estate. There are very real risks in real estate. What I want to know is how you're mitigating those risks. Do you see them? And then how are you working around them? For a fund-to-fund person, what is your relationship to the underlying investment? Are you the one in control of that investment? Or are you just taking my dollars and you are as well a passive investor in that investment?
So then the question that you're really asking them is, how are you underwriting the firms or funds you're investing in?
And
right?
what controls do you have over that firm's decision? Because any one of the investors that comes into our group, those investors entrust us to know what we're doing on the deals. But we don't give all 500 of our investors shareholder controls. So the people that are investing in this fund that then invest in us, those people don't have decision-making rights. But I don't know what he's telling his group of investors. For all I know, he could be telling them, of course, I have all the control and say so. I could pull our money out at any point in time. I have no idea what he's telling them because I'm not talking to the end consumer, right?
Okay, so then if I, like, let's say I'm the fund manager, right? And I give it to you straight. Look, I don't control these assets, but what I am really good at is underwriting people and the groups and how they make decisions. So what you're going to get from me is I'm going to do all the due diligence for you, and I'm going to put my money in with you, and this is the stuff I'm investing in. So if you want to ride alongside me, do it. So if not, don't. Response to that would be,
tell me what you mean by I know how to run due diligence on these guys. And tell me people that you've looked at that you haven't invested in and why you didn't invest with them. Yep. Right? Don't just tell me the deals that you did. Tell me the deals that you didn't do. Tell me the deals that you did that didn't pan out the way you expected them to. We get that question all the time, right? It's like, oh, but people go to the extreme in that question. They always say, have you ever lost money on a deal? Now, knock on wood, there's no wood around me, but knock on wood, we haven't lost money on a deal. But
yeah, that doesn't mean something happened in the deal that actually brought the return down.
And this is lower. What I always tell them. I always say to them, we haven't lost money on a deal, but we've made mistakes and we've had blunders. And let me tell you about them. And so I give the story about the property in Joliet, our storage building there, where the story basically is when we bought the property, we measured the height to do 2 levels of storage. We didn't measure both sides of the building, and we couldn't see what was naked to the eye, this slope, where basically once you hit the midpoint of the building, there wasn't enough room to do 2 stories. So we lost half of the second floor of units. That was a blunder that we made. Yeah. Lesson learned, measure both sides of the building.
And that hurt the return.
That hurt the return, even though that deal worked out phenomenally for us in the end. But that's a mistake that we made. Lesson learned. Did we lose money? No. Does it mean that because we didn't lose money, we didn't make a mistake? Absolutely not. So when somebody asks us that question, I'm walking them through that whole kind of, storyline. If I have somebody telling me, nope, never lost money, never really made mistakes, and doesn't have a story on a deal where they maybe missed something or got caught in a blind spot, I'm very reluctant.
Yeah, because it means they either haven't been doing this long enough or they're lying to you. That's really, right?
So a lot of the philosophy, a lot of the values, how they get compensated is a big thing for me. Do they have money in the deal?
You look at how they're compensated?
Of course. I mean, look, most of the companies in our space are compensated on a lot of fees. Acquisition fee, disposition fee, loan origination fee, loan guarantee fee, property management fee, asset management. The fees, like we've seen some offerings where the fees are crazy. And that's not that that's bad. It's just that's their revenue model. I just want to understand that revenue model, right? I may have a bias towards investing with a fee-driven group because I want more of the profit. And to me, I think the profit is where it's at. Or I may be driven to invest in a group that has little to no fees, but they take more of the profit because in my mind, their incentive is to perform on the deals because that's how they make their money. I'm not saying one is better than the other. I'm just saying I have my bias and I want to make sure my money is going where my bias is. So that would be the kind of next thing that I want to figure out. And then the big one is shareholder control. If you're going to take my money, what mechanisms do you have in place with the underlying investment to make sure that as things go south, or if something, catastrophic takes place, you have the ability to step in and take control of the project? And if you don't, now I'm basically I'm not putting my money with you anymore. I'm putting my money with the group that you're investing in, and I'm at the mercy of their decision making, and I don't even know who they are.
Right.
And so if I don't know who they are, how could I feel comfortable about putting my money with them? And that was the part that was interesting to me. I mean, again, I'm not hating on the guys at all. I think if they're able to go out there and sell and raise that kind of money, kudos to them. All the best to them for being able to do it. I appreciate that and I admire it. I just think if I'm writing a check, I wouldn't be writing the check with those people that are based on the conversations I've been having with them.
Right. I totally get that. Now, this is interesting. I never thought of it this way because I'm like you. Like when I make investments, I want to know who the people are. I want access to the principals and the decision makers. But what do you say for and look, I'm a big believer in advisors, but would you make the argument that that's similar to an advisor kind of structure, that you give your money to an advisor and then the advisor does the due diligence on the companies that they're going to be investing in? It's the public market, but you don't have access to the decision makers, right? Is that necessarily a bad thing?
The same vetting process, though, goes with the advisors.
Right.
Right? We talked about this in the last podcast. We talked about if I'm going to invest with a financial advisor, how are they making their decisions? How are they evaluating my asset allocation?
Yeah, but the control, you're correct.
The control they don't have.
Right.
Yeah, the control they don't have. But 1 or 5 pieces of real estate is not the same as an ETF that has hundreds of companies in it, right? You can't control that, which is why you can't control public REITs either, which is real estate, but it's publicly traded on the market. But if I'm telling you, hey, I'm this fund manager, I go out and I find these individual developers that are building this project, and this project, that's I'm much closer to those deals than I am to, mutual fund with thousands of companies across, multiple, sectors. There's a big difference there.
So, touching on fees, this is something that we see pretty often, that some people are so mindful of the fee that they don't care what the return is. If your fee is too great in their eyes, they're not investing with you, even though the return might be greater than them investing with a different company with a lower fee model, but also a lower projected, net return. Where do you land on that? Are you indifferent to the fees? Are you focused on the dollars that actually go in your pocket, or do you pay a lot of attention to them? Not what the fees are, the amount.
So I don't pay a lot of attention, but I also don't pay no attention. That's not grammatically correct.
Okay, so
I'm not here and I'm not there.
So you got Mikey right here. Fund A, right? I'm Fund B. I'm going to charge you 2% management fee, 2% acquisition fee, and 2% disposition fee. I'm feed up, right? Maybe with a 5% development fee. So I got fees going, right? And maybe a 30% carry. Mikey over here has a 1% management fee, a 1% acquisition fee, 1% development fee, 1% disposition fee. So he's 50% of my fees, right? And we've got the same carried interest. Maybe actually we'll give him a 20% carried interest.
And you?
Mine's 30, right?
So you're fee heavy and higher carry.
I'm heavier all around, right? You are paying me way more money to invest with me than you are him.
Experience?
Same real
projected returns?
Mine are greater.
By how much?
Let's say investing with me, it's a 15% net IRR in your pocket. Investing with him is 11. Who are you investing with? How we make decisions is the same.
Asset classes are the same.
Everything's the same. I'm just better at finding great deals than Mike. So there's more room in my deal, so I pay myself more.
But your historical performance is the same?
All things considered.
So I wouldn't go with you, not even for a moment.
Why?
Because your historical performance is the same. I don't care what you're projecting.
No, my historical performance is 15. His historical performance is 11.
So your historical is better, plus what you're projecting is better.
Yeah.
Okay, so
I'm
I thought
just
it was
richer.
Got it. I thought everything else was equal.
No,
other than the target.
everything equal in the sense of there's the only thing that is better about my offering is I'm showing a higher projected return for you, but I cost more, right? Who are you investing with?
I'm probably going to go with you. And I'll probably do that because...
Sorry, Mike.
Yeah, sorry, G. I know. It's not a reflection on you. I wanted to go with you. Trust me. I was trying to find ways not to go with him. Because net of the fees is really a major driver, right? Look, if you're doing the heavier lift and you're doing a lot more work that's yielding me a greater return, I'm willing to pay for that, right? It's just like the concept of going to an attorney who costs $150 an hour versus an attorney who costs $500 an hour. In this life, unfortunately, or fortunately, depending on how you look at it, you get what you pay for. And sometimes the better people for you to put your money behind, they're going to have a little bit of a higher fee. But you don't generally have one guy with more fees and the other guy with less fees, but everything else is equal.
Yeah, that's right.
You generally have a number of variables that are different. So like in your example between you and Mikey, I would look at, okay, experience, historical performance, the profit share that you're taking, how much money are you putting into the deal? Tell me about deals that have gone bad and how you've mitigated. I mean, there's now a whole conversation that needs to be had, and I need to be able to feel comfortable that you have a good grasp over what you're doing, because if I'm going to put my money with you, I need to understand that it's being put in a vehicle that's not, forget make me money. I need to make sure it's being put in a vehicle that's not going to lose me the money. You know, because that's...
Little burp. I decided to drink some sparkling water. Whew. All right. This is Iowa all over again. Sorry.
I was right into the mic, too.
Go ahead. I know. Sorry, people.
So it comes down to... It goes beyond just one metric.
Yeah, the point I was getting at is that
but these people that are the fund managers, I don't know what experience, and again, I'm basing it solely on my conversation with them. I'm expecting somebody who's managing 5, 10, 30 million bucks to come to the table and the conversation to be very different than the conversation I'm usually having with like a $100,000 investor. And again, it's not to knock the $100,000 investor, it's just the conversation is usually very different. Somebody who's representing $35 million worth of capital should be asking very different questions than somebody who's investing $100,000 of their own. And when the questions are on par or arguably even less sophisticated than what I'm getting from a retail investor, that makes me concerned that the money that they're managing on behalf of other people may or may not go to the right place. And that's the part that scares me, that makes me think, okay, if you are one of those investors that invested in this fund manager who's then going and doing deals on your behalf, make sure you are vetting that person. You're asking questions, you're interviewing them, you're assessing the risk of what goes on with them. How much money do they have in the deal? What mistakes have they made? Don't just invest because you know the person or you're being sold.
You know what we should do, actually, just as you're saying that? We should do a PDF of all the questions that an LP should be asking the operator or the fund manager. Like just a one sheet. Like these are all the questions you need to ask, and this is what we would think the answers need to be. That'd probably be pretty helpful. Because,
I mean, how many times have people brought us deals that we look at, we're like, no. No. You just looked at a multifamily deal in Texas, didn't you?
Yeah.
For somebody.
Yeah. Yep. Deep value add.
And what was wrong with it?
Well, look, there were things that I didn't like in it. That doesn't mean that that's not something that somebody would overlook, but newer group, right? The group hadn't been investing that long. For me personally, like I want to be investing in people that have gone through a downturn, you know? I'm not a big fan of the deep value add stuff, so didn't really like it there. Bridge debt and it's floating rate. So, you know, you can make the argument that, oh, well, yeah, interest rates are going to drop. You can also make the argument right now that they're not going to, right? And so I think that's risk, It just the deal. One, in the area, it's not a market I want to invest right now. Two, I don't like the deep value add stuff. So even on those metrics, it didn't fit. Three, I don't like the floating rate bridge debt. Didn't have the experience I wanted. And the projected return wasn't that exciting.
So if you had a fund manager that came to you and basically sold you and told you, look, I know how to pick great deals. I've, historically achieved X over, let's say, the last 7 years. This is what I charge, which is very reasonable. And I'm going to be putting you in these real estate deals, and you love everything that you're hearing. All the things that you just identified as reasons why you didn't invest, you would have never gotten exposure to.
Right.
Because you're not seeing the underlying deal that I would be putting you in. So I would be putting you into that deep value add project in Texas where you take issue with the debt structure, you take issue with the value add component. I know you have an issue with the market in Texas, right? And so there's 3 variables right there in and of itself that if you saw the deal, you would pass. But you're not seeing the deal. But you're investing with me, and I am not even showing you where it's ultimately going. And so I guess what I'm getting at is that if you're going to take multiple degrees of separation from a deal, do it with somebody who you feel really confident in, because there is a concern there. I mean, it's like investing in something I'm not seeing. I don't know that I would do that.
Yeah, I think it. Yeah, I think if you got to find some type. Look, if you're letting anybody manage money of yours, anyone, you got to trust the person doing it. So I think you got to do a lot of due diligence on that individual, right? How do you feel about, when we talk about fee structures? That's actually one thing I liked about the deal. Their fee structure was very low.
What was it?
It was like a 1% management fee and like a 10% carried interest, like super low, right? Which is how I think they got to the targeted return that they were trying to get to. But also, now that I think of it, they're trying to exit that thing fast, right? Quick turnaround time. So that drove the IR up as well, which I'm not a fan of turning these things. The turn and burn is not for me. I want to build them. I want to hold them. I don't ever want to let them go.
The question is, if you can't get out of it 3 years from now, what happens?
Exactly.
Does the deal fall apart at some point?
And that I think is a little, there's a risk there right now that we're watching happen with syndicators, right? Where they expected things to be a lot better in the future than they ended up becoming. And when they moved, or when they got to a point where they were getting out of their bridge debt and had to refinance, they didn't qualify anymore, right? The value wasn't there. The bank just wouldn't lend like they were 2 years prior.
I mean, think about how. Let's say I put my money in with let's just say I went straight to the syndicator, right? I put my money in on a 100-unit apartment building development project. How many developers have come to city council and said, I'm just waiting this thing out at this point?
There's a lot right now.
So if I was expecting 3 years to exit because the thing was going to be built, leased up, and sold within 3 years, I've heard some of these people at city council saying they're putting their projects on ice for 2 years. Well, shoot, my timeline just got pushed out. I don't know what's happening to my return.
Right.
And it's one thing for a project to get delayed because of construction delays or city taking a little bit longer to approve it. But for the developer to just say, I am not pushing this thing through because of interest rates at all, and I'm just going to wait this thing out, that to me is like an indefinite window of time.
Right.
I have no idea where the interest rates are going to go. And so, there's those things as well. You have to understand what you're getting into. And again, when you're removed from the project by at least that 1 degree of separation, you have no exposure to it.
Right.
That's concerning to me.
We were talking about something I think goes into this. When you talk about fees, right? And you said you want to see the people you're investing with have skin in the game, which I totally understand. This is a question that we got asked when we were raising money for St. Archer. It's a question we've been asked for the last X amount of years.
I get asked that question almost every conversation.
Okay, so now how you have skin in the game can be done different ways, right? It's you actually putting your money into this deal, or what a lot of syndicators or operators do is they take a percentage of their fees or the fees, and then instead of them collecting it, they put that into the deal, right? Do you care one way or the other how that's done? Or do you feel like it's more valuable when you're taking money out that you actually already have and rolling that into the deal? Because it's both your money technically.
Yeah, to me, I like when people are putting their own money in the deal, but I don't know that I'm hating on the other way either. So if I had a preference, I'd probably have a preference for the former. Don't know that the latter, though, would make me not do a deal if I liked other parts of the deal.
Yeah, because I could just look at you and go, hey, dude, I'm going to pull this money's in my pocket anyway. Like when I close on this thing, I get this 2% or 1%.
Yeah, which is why, like, to me, that's, I don't know that, I don't know that that would move the needle for me. But I want to know that you have participation in it. That's the big one. How you have the participation, I think, is a little bit less important as long as I think it's fair and it makes sense.
All right, so then let's finish with this. For anyone who's invested in a fund-to-fund, should they be panicking right now, or are there just some questions that they can be asking to just know if they're invested with the right person or not?
They need to ask questions. They need to make sure that they have an understanding of where their money is going. And this is not just the fund-to-fund guys. This is with anybody. Even if you're investing direct, who are you investing with? What are you investing in? Why are you investing with them? Do you have some sort of a baseline knowledge in the private equity space? Some sort of a baseline knowledge of where the money is going and how the person that's managing the money is making their decisions. And ultimately, do I walk away with the feeling that they are going to execute in my best interest as one of the investors?
Okay.
If I can walk away feeling that feeling, I'm feeling pretty good about it.
Okay, so then what we're going to do, we're going to have this one sheet built out and ready for you at the time of launch of this video. So I'm just going to call it out here now. Hope I don't regret this. You'll have in the description, we'll have a link to a PDF that you can have access to so you can make sure that you are asking the operators or syndicators or groups like us the right questions to help you do your due diligence to find out if you have a good investment or not.
Yep, that works.
End it there.